Okay, everyone here at the Investing Stuff You Should Know podcast. We have another great guest with us today, DylanMarma. Dylan is a principal of the Requity Group. I think I'm saying that right. You can correct me. A vertically integrated real estate private equity company. Dylan has been investing full time for the last 4 years and has been the lead sponsor of over 100 million in transactions, including over 750 multifamily apartments and 1,200 lots of manufactured housing communities and RV campgrounds. Finally, Dylan is a firm believer that through careful deal selection, attracting exceptional people, and utilizing technology-backed systems, you can ensure above-average risk-adjusted returns through real estate. So with all that being said, Dylan, thanks for being here with us.
Thanks for having me, Johnny. Excited to be here.
Oh, fantastic, man. Fantastic. So a lot of us in the space, we see different things going on. We're on social media. We're going to meetups, this and that. So I've been watching you for a while, man. You do cool stuff. I see your social media posts. I like the thoughts you share and insights, but give the audience a little background of where Dylan came from and how he got into this commercial space.
Yeah, sure thing. So initially I'm from upstate New York. I was born into about an hour and a half north of New York City. And at the age of, I went off to school in upstate New York. I was initially going to pursue accounting, and around the age of 19, I caught the bug for entrepreneurship, and really took a major pivot to, at that time, trying to pursue this whole lifestyle by design. And after failing my way through a few early ventures, found my way to real estate and saw that being an awesome vehicle, something I could really run with. And I picked up and moved at 20 years old off to sunny San Diego. And at that point, I got a job for a real estate investing and education company that was fortunately in the early stages of shifting from investing in residential sort of fix and flips to partnering with operators throughout the country that invested in different commercial real estate asset types through the syndication model. So getting that early exposure for me was really crucial and really opened up my eyes to this model. I fell in love with the model as a whole. As many, I got started off, I did buy a few single family rentals, and then I bought into my first 21 unit as a joint venture with a few partners, and then really set my sights on going full-time into multifamily syndication because I was young and had the ability to take the leap of faith and just sort of quit my job and go full force and move out to the Southeast so I can be more boots in the ground, build good contacts and connections. And that's pretty much what I did. So sure enough, I got out to the Southeast, partnered with a few guys that had some existing multifamily but had not yet raised capital. At that point, I had been studying it for a few years, so I was able to come in as a young sweat equity to help us begin to bring on outside capital, begin to scale the business. So together we went out and purchased just about 800 or so doors of multifamily throughout Tennessee and Kentucky. And then after a few years of doing that, and also just soaking up all the information I possibly could, and also learning the property management side of the business because we did self-manage at the time. I really, my partners and I split in different directions. I think at that time I had an interest in continuing to grow in sort of the real estate private equity space, and also caught the bug for mobile home parks and just saw some, good risk-adjusted returns in other areas. So at that point in time, I formed TRG, and now this takes us back about 2 years ago. And once I started TRG, the Requity Group, we started looking at a ton of mobile home communities, ended up finding our first deal on the coast of North Carolina. Just actually had a successful refinance on that deal, closing today, actually. So nice. We were able to take that one full cycle. But after the first deal, we went on and purchased 14 other deals in the last few years. And we've been extremely active buying mobile home communities. And that also led us into RV campgrounds, which we've been more active with in the last 6 months or so.
Yeah.
But we love the business model. We are vertically integrated still today. So we have over 30 people, most of our people being on boots in the ground on-site management. And then we have our sort of internal leadership team with acquisitions and investor relations, things along those lines.
Yeah, let me pause you there, Dylan. So I know we're jumping back here. So the skill sets that you picked up from that group in San Diego that you work for, I thought I heard you say that like you saw this, it was kind of startup country, startup land, saw a bunch of different things. Did you say that you kind of learned some capital raising techniques within that group, or you made connections and or both?
Yeah, it was definitely both. It was definitely just making some great connections to learn from, and also starting to learn aspects of what it took to raise capital. And then I was also
I'm all about the tactical. So give us like 2 pointers there. Like give us like some things that people listen to this like, hey, I could go do that. What Dylan learned. Give us 2 things there.
Well, I think the first thing is developing a framework that works for you and getting that initial sort of blueprint. And my blueprint hasn't really changed very much since the very beginning. And I've stuck to it and found it effective. From a tactical perspective, I think on the capital raising side, I like to, when the deal goes under contract, sending out an initial thoughtful sort of teaser email with the highlights right out the gates, right? And then following that up, usually within 1 to 2 weeks with the full on deck, right? And if you do a deck well, I think that does a lot of the work for you, because it shows the amount of thought you put into your business plan. It shows the pro forma projections, and hopefully you put a lot of thought and attention to detail into that. It shows your capital, your CapEx budget. And I think that doing a really, really good job on the deck. I've had, times where I've been up all night just getting the deck ready to go on the day that I said it would be ready.
Right.
So that I think does a lot of the work for you. And then from there, following that up with a webinar that will then present the details, behind the deck, and give you a chance to present yourself, the team, share your story, share the deal story, and answer any questions or things that have been, commonly coming up in your conversations with investors. And usually if you do that right and you follow that to the T, I think you have a much higher probability of an effective early raise or an effective raise in general, versus I think the big mistake I see a lot of people go into their early fundraisers with is just not having a plan or a blueprint, and just picking up the phone and calling someone and saying, hey, I got a deal. Do you want to come invest? Blah, blah, blah. Right. And they didn't pre-seed and actually warm investors up before sending out their initial teaser email and the webinar. And then 2, without that sort of cadence that sort of does a lot of the presenting for you. I think it puts you in a position where you're sort of behind the 8 ball and maybe coming off as either desperate or unorganized, right? And it definitely does not present the same as having a good process.
Absolutely. And what would you say the source, and because we're talking about this group of people that's super important in the fund and the syndication space, your passive investor base, where have you found success and where have you cultivated that group of folks?
It's really a wide variety of sources. Frankly, when I started off, I did not have a large base of family or people I grew up with to invest in my deals. I've had very minimal of that at any point. And a lot of the early investors were industry connections. They were usually either active investors or people that were pursuing becoming active investors, just because that was the group I had been surrounding myself with, right? So that was a lot of my early investor base, and some of them have continued and worked with me over the last 5 years. I've been doing this full time on many deals, and then I think it's sort of shifted over time, and it's shifted into more of a base of a lot of folks that are working. I kind of look at it like most of them fall into 2 buckets. One that are sort of maybe age group. If I had to ballpark it, I'd say like 35 to 45, very ambitious, working successful careers in finance or technology or maybe sales. And they're just looking for, a place to be able to invest their discretionary income. And maybe they're listening to a lot of either, podcasts or reading up on, studying up on the investments. And then two, we have another bucket that are maybe past that point in their career, and now they're looking at retirement and thinking, I'd like to, find someone that thinks long term, that has cash flow focused investments that can help me sort of replace my income, and have some sort of stability in my retirement, because I don't love investing in exclusively the stock market kind of thing.
Yeah. Do you find that those, and I've noticed that as well in my investor base, do you notice that they will go, or they like certain assets better than other assets? So let's say bucket one likes, mobile homes, and then the other one likes whatever else you got going on. Is that true, or what have you seen there?
Yeah, I think that what I find very often is that you have some investors that they come in and they're from the get-go will say, hey, I am an IRR focused investor. And usually when I hear that, that usually is it's telling me that they're probably shorter term, right? They're probably interested in selling, because when you sell sooner, you get a higher IRR, generally speaking, on value add deals. And that also means that they're not really interested in cash flow. They're more of the type of investor that's like, I don't care what the yield is. I want a high high pop on the the refinance or whatever the capital event is if we sell. And then I have some that do prefer that nice steady cash flow, and they would be upset with me if I sold early, because they either are investing for the tax advantages or the cash flow, and they don't want to kill the golden goose kind of thing. And over time, from the get-go with Requity, we've been really focused on investing long term. We generally have more of a 10-year timeline where we say we're gonna go in, drive value in those first 3 to 5 years, refinance, return a lot of the initial capital back. Usually by year 5, we're targeting to get the amount of your initial investment back into your pocket in the form of cash flows and refi proceeds, and then we'll continue to hold it. And if we sell it, it'll be likely year 7 to 10, and we'll probably do it through a big portfolio sale, so we can get a compressed cap rate at that point in time. So I think most of our investors lean in that direction, and most of our investors we are also big fans of, if we do sell, having some sort of a replacement property to 1031 and 2 when that time comes.
Precisely. Yeah, precisely. Is it true that when you started out kind of from the San Diego and started going kind of the initial work, were you syndicating most of those, or following the syndication model, or did you go right into the fund, kind of the fund model?
Yeah, no, when I started off, the first I did a few joint ventures starting off, right, which weren't formal syndications, and the first individual deals done were done via
JVs. Okay.
standard. Yeah, did a few JVs, but then also moved into the first 4 deals being done on standard 506B fundraises, and then after that, we went into launching the first fund. As a 506C fund, and that is definitely a very different model from capital raising.
And just for the audience, the 506B is you can take non-accredited investors in that up to 35, and then C is accredited only. And then another distinction is that they can advertise one and they cannot advertise the B, because you need to have a pre-existing relationship. Just for any audience that's new and maybe is doesn't know what those things mean, but anyway, it's just a little detail there.
Yep.
So then, and within the Requity group, then is that like just the fund model now? And then why did you decide to go into that, and what made sense there, or why did it make sense to do that? Yeah.
Right. So right now we just finished raising on our 3rd fund under the Requity group, and the reason we initially were looking at the fund model is because it was for a few reasons. One, because we thought we had a plethora of deal flow. At the time there was just where the mobile home cap rates were when we first started pursuing them was pretty advantageous. And
when was that, just for the audience?
That was just about 2 years ago.
Oh, so really very recent. Like, we're not talking like a decade ago. We're talking like recent. Yeah.
No,
these things shift.
Yeah. It's definitely they do move quickly, right? So I think it was a timing thing where it made sense, because we had a consistent deal flow, because we didn't want to be in a position where we did a fund and we were under pressure to raise capital and it was hard to find deals, right? So we felt comfortable in that sense. And then 2, a lot of the deals we were pursuing are small deals. So if we were to go out there and do a one-off fundraise for $1 million, we would have been oversubscribed a few times over again. And then you're just, making people upset that they're not getting in the door when you launch a deal, or you're picking favorites, right? So for us, it just made more sense to, raise a $10 million fund that we could then go spread over 10 different deals versus having all these, sort of smaller fundraisers going on over the course of that year. And then, so I think the size of the deal flow for us was a huge driver in that sense. If we were pursuing deals that were, $10 million equity checks, I think, given our, being still new and earlier in the business, I think we would have just pursued them as individual fundraisers. So that had a lot to do with it. And then moving on, it was the same concept. I think we had momentum with the model. I think we saw the advantage to the investor of having diversification and sort of spreading out your risks in terms of the different, exposure to either the different types of value add mobile home communities or the RV campgrounds. So I think from the investor perspective, it definitely reduces your risk. I say you have a little bit less of that chance of hitting that one home run deal, but most investors, are not looking for just trying to cherry pick the very best deal, and you never really can predict it looking forwards. So I think a lot of investors are comfortable having a blend of many different deals and having sort of the different risk profiles. Like some might be higher cash flow early on, some might be lower cash flows. So it sort of evens out your cash flows. And then you have refinances taking place at different times, things along those lines. So I think I think that had a lot to do with it. That's where we saw the big advantage from the investor side.
Nice. And did you set that up? This is from my knowledge. Did you set that up as a general or a blind fund, Dylan? Is that what that is?
It was a blind pool 506c fund. We do 506c on those, limiting to accredited investors, just because if we do talk about it online, we just don't want to have to be sort of skirting around when we can talk about it, when we can't, because it's going to be open. It's a little bit of a slower capital raise. Doesn't get raised, at least we don't raise them overnight. It's usually something we'll have open for a period of maybe 6 months, up to 6 months at a time. So we like to be able to talk about it without worrying too much about are we advertising and that kind of thing.
Absolutely. And so give us a little insight on the, so you're focusing on the mobile home and then the RV spot. Now just recently bought an RV myself. So let's talk about what interested me, and that's RV. So where do you see, just give us some, I'm sure you're nearly an expert or a good expert in the RV space. Where do you see the growth of RVs and parks, new parks coming on? Give us a broad brush stroke there and paint the picture for us.
Definitely. So currently we have 6 RV campgrounds that are exclusively RV. We have one that's also half mobile home, half RV. But we've been really big on the space as we've continued to learn up on it and get firsthand experience in the space. I think what really attracts me to this space more than anything is the fact that it's mostly mom and pop owned. It is really it's really the Wild West, right? It's sort of unconsolidated, much more so than it's sort of where you think mobile home parks were maybe 10 years ago, right? When you hear the stories of back when they used to trade at, big mobile home communities trading at 8 caps or 10 caps or, stories like that, right? And they're very different asset classes, but it's cool in the sense that it's usually either, owned by some of these big REITs, or it's owned by just a handful of us sort of consolidators. It's not like everywhere you look, there's people that, are buying RV campgrounds, right? We're probably
gobbling up all the inventory in a region. Yeah.
Exactly. So I kind of like the fact that, in some sense, in a sense, I don't know how big the party will get, but we do feel like we are early to it. And we have the advantage of being able to go in and find communities that have been, sometimes developed by mom and pops that have been there for 30 to 50 years, and maybe they're charging well below market rent. Maybe they don't have any online advertising. Maybe they don't have any online booking. Maybe the bathhouses need a lift, or it's lacking amenities. And we have the chance to be able to go in there with a fresh set of eyes, a fresh set of capital, and be able to invest into these communities, to be able to just improve the guest experience, to be able to drive obviously the income. And it's a fun business to operate in that sense, being able to make that sort of impact. So we're all about creating quality communities, and this has definitely been one of the most rewarding areas to do so.
What are some top amenities that people enjoy that you see? Like obviously there's a whole suite of things you could choose off the shelf of what you're going to do. What are some top things people that are a little more like a little more niche that Dylan and his team are doing that's exciting?
Sure. Yeah. So we're not really turning any of these campgrounds to the next Disneyland, right? We're not going over the top with like, giant water slides and, boat tours or anything like that, right? But we're generally targeting sort of the, say on average, sort of the middle class, sometimes upper middle class, just sort of depends on where we are. But our general model is to go after nice quality communities that oftentimes are on major bodies of water or have good natural amenities. And in terms of amenity sets, the first things are just getting the essentials down, which often surprisingly can be lacking. So
Really?
they may not have a bathhouse, right? Or if they have a bathhouse, it might be in really bad condition. So having a nice clean bathhouse is an essential, because people that are in RVs sometimes, if they have multiple people staying in there, they want a nice clean shower. Having a good bathhouse goes a very long way. That gets a lot of use. Having a good laundry house is also important, because RVs have really small all-in-one washer dryers. So being able to get out and use a full size, washing and drying machine goes a very long way. So
Yeah.
that bathhouse and laundry room are the first two. Then from there, we look for ensuring that we have a quality community gathering area. So having a nice, gas or sometimes wood fire pits with, we get the Adirondack chairs and the string lights, and just sort of make sort of a gathering area, that people can come out and be able to, hang out in the evenings. Goes a very long way. Generally, we're putting in dog parks. And then updating the roads can be a huge thing, right? A
Oh
lot of
yeah.
times the biggest complaint are potholes or old dirt roads, and we can just either turn them to gravel or pave them and just improve through that. Sometimes we upgrade concrete sites as well, can be really helpful. We'll get a fresh, usually all new picnic tables in all throughout. So every site gets their own nice picnic table. And it's a lot of the little, the attention to detail and the landscaping, making sure you have a really good landscaping crew, making sure you're just cleaning up the grounds. That goes a super long way. And
Yes.
then the most important thing, in my view, is the event schedule, right? So
Mm,
once you've gotten all the essentials taken care of,
yeah.
it's not about getting the big fancy amenities at that point. It's I think about having really quality events that sort of keep the campgrounds as a fun place. We have a lot of our campgrounds are long-term and some are short-term, but either way, we focus on doing events generally every weekend. Sometimes they're small events, sometimes they're larger events. It varies based on the sort of the size of the campground and
Give me an example of an event. Like give me a fun event that you thought was pretty cool. Give me a sample there.
yeah. So I know last weekend there was a pirate themed event, right, where you had the managers dressing up as pirates and kids running around dressing up as pirates and giving out gifts and things like that, like fake treasure and things like that. I know we do quite a bit for Halloween. One of our campgrounds, actually two of them, do pig roasts every year.
Oh wow.
That's a really popular one. Then we have some that are more local, to that part of town. Like one of ours has a big shrimp festival that's part of that local city. So that we make sure to throw a big event for that. I know Halloween has become multiple weekends long. It's usually the entire month of October is all different types of
Well, that's coming
Halloween
up.
events.
It's
So
about a month
yeah,
away.
exactly. So I mean, I really have to give credit to our management team, right? It's usually not me planning these events. We have a great team. One of our regional managers came in from after working for our Sun and ELS, the two big REITs that have the biggest ownership in the country. He came in with a lot of fresh ideas of different
Nice.
awesome
Yeah.
events that we could be able to sort of bring to life. And I've been blessed to not have to, come up with all of these creative ideas and just watch our team, do what's best. And we have a Slack channel where it's just filled with pictures of all of our events and everyone having a good time. And, that always is really rewarding to see.
Fantastic, man. Pivoting back to, I guess, the comparison. So your latest focus is on RV parks and mobile homes. What's the profitability there? I mean, like you could put it in whatever terms, like, there's cap
Sure.
rates and there's, margin
Cash on
and whatever.
cash. Yeah.
Yeah.
Yeah. So with, With the mobile home communities, I think right now the industry's gotten, I like to say for people that are more familiar with multifamily, it's pretty similar to multifamily now in terms of where the yield is and the cap rates are. Very, very similar. I think everyone's woken up to the fact that the average resident that in a tenant-owned home stays 15 to 20 years. It's an extremely sticky resident base, extremely durable form of cash flow. And the NOI growth is tremendous because you have pretty low fixed expenses. So oftentimes you have a very predictable NOI growth year over year ongoing, making it a really great asset as a long-term hold. On the RV campground side of things, the campgrounds vary so different. They can be so different in the sense of some being ran like they're motels, some being like hotels, some being resorts, and then some being more like apartments, long-term stays, right? So you have a huge variety of different types, and naturally, just like just like a hotel trades at a higher cap rate than an apartment building does, a short-term RV campground is going to trade at a much higher cap rate than a 100% long-term RV campground. So
Gotcha.
our model is more of a 70-30 model, where we like to have about 70% of our portfolio be long-term annual site agreements, sometimes referred to as seasonal site agreements. And then about 30% being more of the short-term stays that are more in and out, there for weekends, a few nights at a time, a few weeks at a time, that kind of thing. You're going to get higher yields on short-term. If we were targeting a completely short-term community, we would generally target somewhere in the, say, mid-teens as our sort of cash on cash threshold to purchase a good quality short-term community. And that could be higher if it's in a riskier area, or lower, if it's in a really, really quality area. Whereas on a long-term, we're generally more comfortable with somewhere maybe around a 10 to 12%. It's going to be a little bit lower yield, but still compared to where a lot of real estate is, a very quality yield available on more of the long-term RV campgrounds. And obviously it's all subject to change, but that's around where the market is right now.
So man, yeah. So that's gave me insight. Obviously, like I hadn't realized that or didn't think about that. So, which is obviously why I talk to people like yourself that do know about these things. Do you see the RV space, and we're kind of bouncing back forward between RVs and mobile homes, but do you see the RV space remaining strong, and why is that?
So right now, I think with the looming recession and talks, and gas prices rising, I think there are some threats that have made some investors either pump the brakes or at least question how the RV campground space is going to be impacted. We have not seen a material slowdown even with that, and we think that there could very well be a slowdown on the short-term stays if we go into tougher times, which is why as an owner, we're long-term focused, but we still like the sticky revenue that comes from annual site agreements. So we're okay taking a lower cash flow, but having that sort of peace of mind, knowing that we have a lot of long-term folks that, ideally we can have them be there for many years on end, decade plus of time. Just being able to really cater towards a lot of that audience. And then the short-term side, though we've still been doing very well with that to date, we just think that there's a possibility of a slowdown in that sense. I think from the investor side, this is such an operations intensive business. I think that's a huge difference with this in mobile home communities is if you had an all tenant owned home, mobile home park, it's really not super difficult to learn how to operate that. But if you have an RV campground with people moving in and out and all kinds of, different guests calling in at all hours of the night, and, you're having all these events and you need, really quality on-site staff, it definitely can be, you have a lot more headaches that come along with that. So we think that that's sort of a natural barrier to entry that's going to stop a lot of operators from entering because it is a lot to figure out. So we don't think there's going to be a huge, mad rush into this space, anytime soon, but you never know. So
I love that. I love that strategy. So you got blue ocean, red ocean, and then also the barriers to entry, and you're choosing your competition, indirectly or directly, and how many people could just rush in there and do this. So that's a huge thing. And I was going to ask about that, but you answered it without even asking. Was the operational challenges and like what is that pros, cons, things like that, and you kind of answered it. Obviously, the fact that you're successful tells me that you have it figured out and you've brought on some excellent talent. It sounds like as well, and that also prevents other people from just jumping in there like, oh, this is just a bunch of people, living here for a month and they just leave. Or
I've met a
leaving.
few people that bought RV campgrounds and they tell me they'll never do it again. Like some of them bought even a few of them and they're selling them all. And they're like, I can't do this. This is just way too much. So I mean, it's stuff. And for me, I don't know what's wrong with me, but it's only grown on me more and more the more we've bought. So I guess it's definitely not for everyone, but I think for people that sort of enjoy leaning into the operations side and getting into the weeds with the KPIs and, building the team and that kind of thing. I think it's, there's a lot to be said about that. But for people that really are more just maybe acquisitions focus and want minimal operations, I think this is it's a tough industry to jump into.
That's so good, man. Well, that's a good wrap here. Thank you for sharing that deep and good knowledge and broad. And we obviously started out talking about, the way of how to get into it and what your own path. And we wrapped it up at the final end here with their in-depth and detailed knowledge about the RV space and some about the mobile home parks and the contrast between the two. So how would folks, if they want to work with you or reach out or to know more about this, what's the best way to get in touch?
Yeah, so I would say the best way is you can definitely plug in on LinkedIn. I'm always active on there if you wanted to just reach out and connect there, or you can go to our website, therequitygroup.com, and on there you can click get started as an investor. Even if you just want to plug in just to simply jump on a call or tune in with our upcoming investments to just kind of watch from the sidelines. We welcome that anytime.
So good, man. So good. So again, folks, DylanMarma, he's with the Requity Group. He's got some cool stuff going on. If you're just intrigued about the mobile home or the RV space, and like you said, if you want to just passively kind of lurk in the back and just see what's going on, he's the guy, he's the team you want to connect with and get in contact with. So we thank the audience for listening to another episode of the Investing Stuff You Should Know podcast. Please leave us a review. We always appreciate that, and give us 5 stars, and we'll see you next time. Thanks, Dylan.
Thanks a lot, Johnny.